welcome to Money, 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 your weekly personal finance date with me, Surabhi Upadhyay. The last few months have seen quite a bit of churn in the mutual fund world, all thanks to a new set of rules which govern the mandate and the market cap classification of funds. Now, several schemes have actually undergone name changes. There have also been a few instances of mergers. Some funds have actually seen a clear change in their mandate, the very fundamental reason behind what they do, whatever they do. So to help us analyze all this and take stock of this ever-changing environment, this week on the show I have with me Kaustabh Belapurkar of Morningstar India. Kaustabh, thanks so much for joining in. It has been a confusing 3-4 months for investors, I think, out there, and even people who track mutual funds.
Yes.
Because there's so much of churn thanks to the rules which were released back in October 2017. AMCs have had the time to go back and forth, decide what they want to do. Your first thoughts, has it been disruptive, or are there, in your analysis now, only maybe 1 or 2 schemes where there is a big change?
Sure. So, I think it's important to sort of lay down the perspective from where the regulator was coming, right? So, the Indian mutual fund industry is kind of that cusp of breakout growth. We've seen great, new investors coming in, a lot of assets coming in. So, it was a point that, it was, I think, a necessary move that they had to take. Because new investors coming in, there's no clarity about what each fund mandate was in the past. So I think just to clear out the air around that, the regulator take the step. Yes, it's probably disruptive in the short term, but probably, I think, a good move in the long term, looking at the trajectory we're looking at assets growing, right? So that's great. And I think the dust should settle in the next few months, where we've seen most of the funds already declaring what their mandates are. Which category they're going to be, the name changes, that's a little bit of a sticky thing, because, these were brands that you associated with, and now you have to get used to the new normal. So it'll take some time, but, I think by the end of this year, everyone should be up to speed. I mean, we're also grappling with that right now. We'll just have to be a little patient. And I would urge investors that, reach out to your advisors, let them handhold you during this period. It's important because there have been some changes, there have been some mergers, so it's important to understand from your portfolio perspective what's really happening.
Oh, absolutely. So what we'll do over the next 20 odd minutes is take you through some of the more important changes that have happened, some of the big schemes, marquee schemes, where either there is a name change or maybe there's a change in mandate, and that's where you need to take stock and really figure out if the fund's mandate now is in sync with your own goals, your own reason for being invested in that fund. So as we start this exercise, Kaustabh, first of all, have there been too many significant changes, or is it largely nomenclature? So then that's a cosmetic change, right? If the name is changing, if, let's say, a word is being taken away or a word is being added.
Sure. So I would say there have been a few changes, but not as dramatic as people on the street expected them to be.
Okay.
Because the one thing that, the new categories have introduced, they've streamlined what each fund can do in most of the categories, but there's some new categories that have been created. So there's space for fund houses to kind of move some of the existing funds into a newer category. And what we've seen that there's been a reasonable amount of similarity in how a fund was run in the past and how it's going to be run in the future, even though technically the category is being changed. So when I say that, to just give you an example, say if we had a large cap fund, which is now going to be run as a multi-cap fund. That's probably why, because the fund already had a large cap fund. So, the rule that you can have only one fund per category. So they've moved that fund into a category where they want to stay in, but the mandate doesn't necessarily change. So I think that's something investors need to be cognizant about, that if your mandate, for large cap holding 70-75% in stocks, in large cap stocks, is now probably moving down to 65-70, it's not a dramatic change in mandate. Whereas someone who was probably, and we've seen a few instances where, say, a mid-cap fund has now become a very thematic focus fund. So those are the changes which would be more dramatic. And that's the one you need to understand, is that a portfolio that's fit for you or not.
Okay, so I'm going to start off with the dramatic changes first up. The one sort of series of funds that comes to mind instantly, where there's actually been a merger of large schemes, and these were big funds to begin with, the HDFC Prudence and the HDFC Growth. Both of these funds have merged together. Now, what prompted this and this resultant fund that we're talking about, the HDFC Balanced Advantage, what kind of a creature is this now?
Sure. So, to start with what the funds were earlier, right? So, Growth was a pure large cap, mostly a large cap, pure equity fund. Whereas the Prudence was an aggressive allocation fund, as we call it, which had about 75% in equities and the remaining in fixed income instruments. Now, Growth being the smaller scheme, it's kind of being merged into Prudence, and they've been renamed as Balanced Advantage. What does the new fund do? It's it's in the dynamic asset allocation category. That means you can dynamically move between equities and debt. It's a no constraint sort of fund. Now, from what we understand in the conversations we've had with the managers in the past, and this might have changed after they've announced this, but from the information that I have as of now is that it's not going to dramatically change from the prudence sort of style of management, which is about 70-75% into equities, the remaining into fixed income. So if I was a HDFC growth fund investor, yes, then it's a change because I was looking at a fund that was pure equity. Now it's become an allocation. But for a prudence investor, it's not that much of a change, as we understand right now. But if I'm so if I'm a growth investor, I'll need to understand that how does it fit into my asset allocation? Should I be looking at exiting this and getting into a pure equity fund?
That was my next question, because you do have that option. I think the window's probably shut now.
Yes.
But investors were allowed to opt out without, I think, any loads if they weren't in sync with the fund's new mandate. What would your outlook be on a balanced advantage fund, and that too from the HDFC stable in the current environment?
So I think HDFC's it's been one of the foremost investors both in equity and fixed income. So we're quite positive on even despite so-called technical change, we don't see any reasons or any hiccups to that fund. We're very happy with the way it's been run in the past with Prashant, and we expect that to continue going forward. So as an investor, I would urge for you all to stay invested, unless obviously if you're looking. If you're a growth investor and looking for a pure equity fund, then you might want to reconsider. But if it's an allocation fund that you're already invested into, then I would say just stay put.
No need to worry. Fair enough. Any other cases of big mergers, or any other sort of fundamental M&A that's happened in schemes that comes to mind? So,
like for instance, there's another one from UTI where we've seen their flexible blue chip fund getting merged into one of their equity funds. But that's an equity with an equity merger, so it's not that dramatic. HDFC had another merger of their multi-cap fund getting merged into their other balance fund, which will remain in the aggressive hybrid category, which again holds about 75% into equity.
So this was the multi-cap fund?
The multi-cap. What was called the Premier Multi-Cap is now being merged into the balance fund, which again had about 70-75% into equities. It will continue to be run with that mandate because the category allows you between 65 to 80% in equities.
That's the aggressive hybrid category that SEBI has now allowed. So watch out for that. Again, make sure that you're in sync with what the fund now intends to do. So these are some of the key mergers that have happened. Let's move to the mandate changes. Where the scheme hasn't merged with any other scheme, yet there is a clear change in its attributes and its sort of mandate to invest.
Sure. So, one name comes to mind is from the Reliance stable, the Reliance Growth Fund. Now, that's been one of the popular funds with investors. And if you look at the way the portfolio has been managed, it was a mix of mid-caps and large-cap stocks. While there was a tilt towards mid-caps, it did have a fairly large-cap sort of holding too. But as per the new categorization, it's going to be a mid-cap fund. That means it needs to hold 65% minimum into what is defined as the mid-cap stocks, which is the 101st to the 250th stock, as per that definition. So that's going to be a little bit of a shift from where the manager has been traditionally sort of managing that. And Manish Gudwani, who's the manager for this fund, has come. He joined last year from ICICI. Great manager. But in the past, he's largely managed some of the large cap strategies in ICICI. But I think he's come up the curve really well managing this strategy. But investors should keep a lookout just because we're seeing that the constraint coming in now in terms of the way the fund was being managed in the past.
Yeah, so you need to be aware that there is going to be higher mid-cap exposure.
That's
so therefore, the risk parameter and how that moves, volatility of the fund, its returns, I think those are some of the dynamics that one needs to keep in mind. SEBI's also come out with the value category. Is there a clear definition of value? Is there any sort of, churning of funds here in this particular aspect?
Sure. So what's happened to the value category is there's no clear-cut definition of what constitutes a value stock. And every manager will use some leeway in terms of explaining what his value style philosophy is. So you will see a different mix of funds within this category, and that is going to happen. So there have been some classical value bend funds, like an ICICI Value Discovery, which Mrinal manages. That falls in this category, and it's always had a value bent of mine, so that's going to continue sort of in that strategy. But for instance, say the IDFC Sterling Equity Fund, which is now falling into the value category, it didn't really have per se a pure value bias.
Okay.
Now that's a transition, in terms of definition and the portfolio that Anup Bhaskar will make with the portfolio. So that's again something. It was largely a sort of mid-cap strategy prior to this. Now I'm not saying that he won't probably run a mid-cap strategy going forward, but he'll have to run it with a value lens.
Okay, we're going to take a break on that note, but the conversation continues. We still have to talk about funds where, again, mandates are changing, where maybe a mid-cap fund is now becoming a multi-cap fund or a flexi-cap fund. Then what do you need to do? What are these examples? We'll discuss it on the other side.